Welcome to today's Explainer. I am absolutely thrilled to guide you through what is shaping up to be a truly fascinating set of events today. Seriously, if you just glance at the headlines from this morning, July 29, 2026, you might just see a bunch of isolated incidents. But today, we're going to look at the day's news for what it actually is, a massive interconnected chain reaction of global events. We're talking about compounding risks, where geopolitics, technology, climate, and finance are all literally colliding in real time.
Let's dive right in. The Daily Tech Reader put it absolutely perfectly this morning. Wednesday begins with a diplomatic pause broken, American forces again under attack, and the Federal Reserve facing a more difficult decision. I wanted to start right here because it perfectly encapsulates the high-pressure environment we are decoding today. This single sentence, it completely sets the stakes. You see, we aren't just dealing with a localized conflict or some standalone economic report. We are dealing with a global domino effect.
To make sense of all this, our agenda today covers four main pillars. 1. Geopolitics and energy markets. 2. The AI market reality check. 3. Climate extremes and health. And 4. The Federal Reserve's dilemma.
All right, Section 1, Geopolitics and Energy Markets.
Let's map out exactly how rapidly the situation in the Middle East has escalated over just the last few days. So 72 hours prior to this morning, we saw more than 30 militia drone attacks. This prompted retaliatory strikes on Tuesday by U.S. and Saudi aircraft targeting logistics and weapons sites in eastern Iraq. And then, the major escalation hit Wednesday morning when the U.S. military actually had to intercept multiple Iranian ballistic missiles launched toward American forces. So that brief diplomatic pause we had, it's been completely broken, and it's very clear that regional militias are actively disrupting negotiations.
Now, while these military strikes were unfolding overseas, major diplomatic meetings were happening simultaneously in Washington. Political and military leaders gathered for Senator Lindsey Graham's funeral, which actually served as a focal point for high-level talks. President Trump met separately with Israeli Prime Minister Benjamin Netanyahu and Ukrainian President Volodymyr Zelensky. With Netanyahu, the focus was squarely on Iran and regional security in light of these new attacks. And with Zelensky, well, discussions centered on reviving negotiations with Russia, as well as a significant proposal that could allow Ukraine to manufacture Patriot missile interceptors domestically.
And here is the immediate economic reaction to that geopolitical instability. Oil prices spiked by exactly 3%. This sharp increase actually completely reversed a 5% decline we saw just the day before. Because of the renewed fighting, commercial passage through the Strait of Hormuz remains severely restricted. Any confidence that the strait could quickly return to normal operations has basically evaporated overnight.
Which brings us to this staggering data point on the supply chain. Tankers' shipping costs on some Asian routes are now roughly 6 times higher than they were just a year ago. 6 times. Think about what that actually means for global trade. Expensive oil and a restricted supply chain place immense pressure on, well, everything. And as we transition into our next section, I want you to keep the supply chain squeeze in mind, because skyrocketing energy and shipping costs create massive hurdles for the tech sector, a sector that relies entirely on colossal global infrastructure.
Moving on to Section 2, the AI market reality check.
The sheer scale of the market correction happening right now in Asia is frankly staggering. We are seeing a cascading sell-off in semiconductor shares across the board. South Korea's Kospi index plummeted by more than 11%, a drop so severe it actually triggered a temporary trading halt. To put that into perspective, the Kospi has now lost about 35% just in the month of July. Taiwan's index fell around 5%, and Japan's Nikkei dropped approximately 2.6%. Make no mistake, this Asian chip sell-off has become the absolute clearest market challenge to the current AI investment cycle.
Now, I want to introduce a stunning paradox. 550%. That is how much SK Hynix saw their operating profit jump compared to a year earlier. They reported exceptionally strong earnings. 550% growth is huge.
But here's what's really interesting, the market's reaction to that massive profit. Despite a 550% profit increase, SK Hynix shares still dropped around 9%. How does that happen, right? Well, it happened because even that explosive growth failed to meet the sky-high expectations created by the AI investment boom. Investors are now actively distinguishing between the real growing demand for AI and the staggering, almost unbelievable prices already assigned to that growth.
Which leads us directly to this vital question. Arguably the most important question in the tech world today. Can AI earnings actually support the massive capital structure built around it? It's no longer a question of whether AI demand exists, but whether the actual cash flow justifies the massive debt and valuations. In fact, the ratings agency Fitch has explicitly identified a major AI market correction as an emerging global credit risk. To really understand the sheer scale of this capital structure, let's look at the financing concerns surrounding OpenAI right now. NVIDIA is reportedly discussing a potential $250 billion financing guarantee for OpenAI. On top of that, future OpenAI chip purchases could involve as much as $350 billion. This is completely unprecedented infrastructure spending. And it's raising serious alarms about circular relationships, where a chip supplier guarantees a loan to accelerate its own sales, effectively placing massive credit risk right back onto its own balance sheet. With borrowing costs rising, projects whose financial returns are still years away are facing some intense scrutiny.
Which brings us to Section 3, Climate Extremes and Health.
So while digital infrastructure is under financial strain, our physical infrastructure is also taking a massive hit. Consider this wild phenomenon currently happening above major wildfires in France and Spain: pyrocumulonimbus clouds. These are clouds created by the intense heat and smoke from the fires themselves. What's terrifying is this feedback loop. These clouds can actually generate their own strong winds and lightning, which in turn ignite even more fires. It is a perfect, if scary, example of compounding climate risks, where extreme conditions literally generate their own weather systems, completely disrupting local economies, tourism, and agriculture.
Shifting gears from climate to public health, this number is a stark warning. 2,318. That is the number of recorded measles cases in the United States right now, making it the highest annual total in 35 years. This is largely because national MMR vaccination coverage has fallen to around 92.5%, with 16 states dropping below the 90% threshold needed to protect local communities.
And honestly, that measles outbreak is just one part of a compounding public health strain. Right now, Michigan is managing over 8,100 cases of cyclosporidiasis. That's a severe infection tied to food or water contamination, forcing a really complex multi-state food tracing investigation. At the exact same time, Canadian wildfire smoke is sweeping across parts of the U.S., increasing emergency room visits for asthma, heart attacks, and strokes. Add to that the persistent extreme heat in places like Texas and Oklahoma, which is literally preventing the human body from recovering overnight. All of these factors stack up, creating a massive strain on our emergency response systems and regional workforces.
Finally, Section 4, the Federal Reserve's Dilemma.
The Federal Reserve faces an almost impossible balancing act today. If you look on the left side of the ledger here, you have massive inflation pressures. You've got a 3% spike in oil, raging geopolitical instability in the Middle East, and 30-year Treasury yields sitting over 5%. But then look on the right, you have severe growth headwinds, a vicious tech market sell-off in Asia, Fitch predicting global growth slowing to just 2.4%, and those exact same high borrowing costs threatening to stall the massive AI infrastructure projects we discussed just a few minutes ago.
I really want to highlight this specific point, because this is why all of this matters to you. U.S. 30-year Treasury yields remaining above 5% isn't just some abstract financial metric for Wall Street. It increases borrowing costs across the entire economy. It impacts consumer confidence, which is already taking a hit from higher gas prices. It affects everyday mortgages and credit cards. And zooming out to the macro level, it threatens the survival of that AI investment cycle, which relies entirely on cheap capital to fund those massive data centers. Most analysts expect the Fed to hold rates steady today, but trust me, the pressure to address these completely conflicting signals is immense.
Which leaves us with this final, provocative thought. We've seen incredible corporate profits today, like from SK Hynix, and we've seen active diplomatic negotiations. But as these domains collide, as military conflicts spike energy costs, which then drives inflation, which keeps interest rates high, which then crushes tech valuations and infrastructure spending, we really have to ask, will strong operating results and diplomatic frameworks survive this ultimate stress test of compounding global risks? It is such a fascinating, interconnected puzzle. Thank you so much for joining me for this explainer. Keep your eyes on these converging storylines, and as always, keep learning.